Hello guys. I hope you are all having a great day. To begin with, there are three types of trading: long-term trading, swing trading, and day trading. Well, today I am going to be talking about day trading. What will I be covering in this course is: what is the stock market? Overall view of day trading. How to choose the stocks. Risk management. This is a very important skill that a trader must learn to be a successful trader. Then he'll talk about candles. Then the most important trading strategies and patterns and why they work. Finally, I am going to tell you what is the daily routine of a day trader. This is also important to know. You should know that this video is only for students that want to learn how to become real traders in the future. So before I begin with the course, I hope you all read this book, How to Day Trade for a Living by Andrew Aziz. Most of the information that are found in this presentation are taken from this book. Also, I hope you like this video. I worked on it really hard, so it means a lot to me if you hit the like button. Let me start by defining the stock market in general. The stock market is a massive crowd of traders where they connect to buy and sell stocks, commodities, crypto coins and forex with the aim of making a profit. They also try to make money from other traders by outsmarting them. You may hear sometime someone saying that the market crashed or something. Well, this means that the whole market is decreasing and not just a specific stock. Because when the market is increasing, the majority of the stocks will increase. The same thing when the market is decreasing, the majority of the stocks will decrease. Now let me talk about what is day trading. Day trading is not like gambling. Day trading is business and it has nothing to do with gambling. You will understand why while we pass through the slides. Second thing, you don't have to keep any positions overnight. Else it is called swing trading. Also, a day trader always looks for stocks that move in a relative and predictable manner. We will discuss this in detail later on in the presentation. Numbers 4 and 5 tell that if the overall market is increasing, we go long, and if it is decreasing we go short. Except in some cases that I'll be talking about now. Well, when the stocks move opposite to the market due to some catalyst. It can be an earning report, earning warnings, or pre-announcements, earning surprises, FD approval or disapproval, partnership, or major product released and major contract wins or losses. So you should always look for the news to see if there is any specific catalyst to take into consideration. So guys, now how to choose the stocks for day trading. 1. You only have to trade with stocks that have so many retail traders trading with. 2. Trading in a stock that no one is paying attention to is a wrong thing to do. You should always look for stocks that are moving every single day and receiving tons of action. In other words, stocks that are gapping significantly up or down are going to be the stocks that retail traders are watching. You do not want to trade in a completely neutral stock with no ups and downs. Also, you can always join a community of traders that groups on the internet to keep in touch with traders and to know their thoughts. In addition to all these, the most important skill to learn if you want to day trade is risk management, which I will be talking about later on in this presentation. The inability to manage losses is the main reason traders go broke. If you are having a bad day trading, do not leave the trades till the next day thinking that the stock will go up. Believe me, you will end up losing all your money someday. You should know that every time you trade, you are exposing yourself to the risk of losing money. I will explain this also when we go to risk management section. Find low risk management with high potential reward. The minimum with to lose ratio is 2 to 1. I'll explain this in a bit. Last thing, well, this is also important to know that you should never overtrade. It is not recommended to trade more than 4 times a day. You should know that day trading only works on stocks that have high relative volume. But this does not mean that the higher the volume of a stock is, the better it is to trade with. In fact, you should search for stocks that have higher volume from the relative volume of the stock. In conclusion, day traders trade only high relative volume stocks that have fundamental catalysts regardless of the overall market. This is a table that I got from the book that shows the float price range and the strategies that you may use. Now let's talk about risk management and the win to lose ratio. Good examples of risk management are, for example, 2 to 1 ratio. That means that you are risking $100 to make $200. Another example, 3 to 1 ratio, which means that you are risking $100 to make $300. I will explain more in the next slide. What you do not want to take risk is, for example, 0.1 to 1 ratio, which means that you risk $100 to make $10. This is a BD risk rewarding ratio that you do not want to take. For example, you buy $1,000 worth of stocks but you put the stop loss at $100 loss. In this way you are risking $100. You must then sell it for at least $1,200 to make $200 profit. A ratio less than that may lead you to major losses. If you can't get a good setup with a good profit to loss ratio, then you should move on and keep looking for another trades. Also, never rely on your feelings while trading. Finally, with the 2-to-1 ratio you can be wrong 40% of the time where you lose money in it but still make a good profit at the end of the day. So what should day traders look for are stocks that in the pre-market gapped up or down at least $1. STCKS that have traded at least 50,000 shares in the pre-market. Stocks that have an average daily volume of over 1 million shares. Stocks that have average true range of over 50 cents. There is a fundamental catalyst for the stock. There are some stocks that you should avoid trading with. First, you don't want to trade with stocks that are heavily traded by computers and institutional traders. Stocks that have small relative trading volume. Penny stocks that are highly manipulated. And finally, stocks that don't have any reason to move. Now, how to read candles. As you can see in this slide, the green candle is called a bullish candle. And the red candle is called a bearish candle. They both have highest points and lowest points. They differ at the opening price and closing price. Now let's talk about spinning tops. At these points the bulls tried to push the price upward but did not manage to hold a significant high. And down, the bears tried to push the price downward but did not manage to hold a significant low. What about a doji? A doji is a strong fight between the bulls and the bears and nobody is in control. Types of dojis. We have the shooting star doji where buyers tried to push the price up but did not manage to hold it, and this is a sign of reverse. Hammer doji, where the sellers tried to push the price downward but did not manage to hold it, so it also a sign of reverse. These are some examples you can see. In the left side the bulls are in control while in the right side the bears are in control. The most important trading strategies and patterns and why they work. In the following slides I will talk about the ABCD pattern, bull flag momentum, top and bottom reversal trading, moving average trading, VWAP trading, support and resistance trading, and trading with divergence, and trading with patterns. Let's begin with the ABCD pattern. As you can see, the price first increases from A to B, then buyers will close their trades, so consolidation period will appear. At point C you confirm that it is an ABCD pattern, so you buy at C and sell at D. Bull flag momentum, it is usually found in an uptrend, so you should not short sell a bull flag. Top and bottom reversal trading. What you should know about it is that what goes up will eventually go down and vice versa. When short sellers start to cover their shorts, the stock will reverse. And vice versa. Some rules of top and bottom reversal trading are: at least 5 candlesticks with 5 minutes range moving up or down. The stock is trading close or outside of the Bollinger Bands. Bollinger Bands are indicator of volatility, and stocks usually stay inside them. The stock will have an extreme RSI indicator either above 90 or below 30. And last but not least, when the trend is going to end, usually candles such as spinning tops or dojis will appear. Here is an example. Moving average trading. First, the trend above the moving average is for being long and a trend below the moving average is for being short. Sometimes a moving average acts as a support and resistance level at different times. Most recommended are either 920 EMA and 50 and 200 SMA, or 1121 EMA and 50 and 200 SMA. This is a good example of the moving average under the prive, meaning that it is bullish where the price also is being rejected by the indicator. That is another example of the moving average acting as a resistance and as a support. You can see in the middle a doji that indicated that the price will reverse. Now trading with volume weighted average price, or as known as VWAP trading. It is a moving average that takes into account the volumes of the stock being traded. If the stock is above the VWAP, it means that the buyers are in overall control of the price. If the stock is below the VWAP, it means that the sellers are in overall control of the price. As seen in the picture below. Support and resistance. The basic thing you should know is that you buy at the support and sell T the resistance. Half dollars and whole dollars act as invisible support and resistance levels. Support and resistance are areas and not specific points, so they can range from 5 cents to 10 cents. Here is an example as you can see in the picture below. Divergence trading happens when an oscillation indicator moves in a different directions of the price. Normally when the price goes down the indicator goes down, and when the price goes up the indicator goes up. But when divergence happens, the price goes down but the indicator goes up. I will not talk more about it though it is the most strategy I use, so check the 5-minute video that I uploaded before this where I explain how and when divergence happens. But here is an example of divergence where the price makes lower highs but the indicator makes a higher high at the same time. This is another example where the price makes lower lows while the indicator makes higher lows at the same time, indicating that the price will reverse as seen in the picture. Finally, trading with patterns where we have inverted head and shoulders, triple bottom, triple top, bearish rectangle, bullish rectangle, double bottom, double top, descending triangle, ascending triangle and the cup with handle. You can watch my first video explaining them all. Best indicators are moving average that identify the direction of a current price trend. Exponential moving average that can help traders confirm significant market moves. It places greater weight on recent data points. Stochastic oscillator is an oscillator that compares a specific closing price of an asset to a range of its prices over time. A reading below 20 means that the price is oversold and a reading above 80 means that it is overpriced. Moving average convergence divergence compares two moving averages. Traders can identify possible buy and sell opportunities around support and resistance levels. Relative strength index helps traders identify momentum. If it is around the level of 90 it is often overbought, while if it is near 30 then it is oversold. Finally, Bollinger Bands indicates the range with which the price of an asset typically trades. To wrap up the presentation, I am going to talk about what a daily routine of a day trader is. Before the market opens, you should scan the market to find stocks with great volumes. With the market going up or down. Search the news to see if there are any catalysts for some stocks. When the market opens, trade the first few hours because it has the highest volume and liquidity. In this way you enter and exit trades fast. Finally, do not overtrade. Never trade too much. Put a goal and reach your daily goal. Before you exit the video, if you have any question or comment, please leave me a comment down below. And like the video, and don't forget to follow me on Instagram for daily lessons and trading tricks. The Instagram page is called Trading Venture. Thanks for watching.